Welcome to This Explainer. Today we're diving into a genuinely realistic blueprint to financial freedom. We're going to completely strip away all the confusing finance jargon and focus directly on the actionable strategies that will actually help you escape the rat race and build real, lasting wealth.
So let's kick things off with a pretty wild question, right? Why is it that society is totally obsessed with university degrees, but the second you walk into a bank for a major loan to, say, expand a business or buy property, they don't even care about your college diploma? They only want to see your financial statement. It's this massive, glaring disconnect. Traditional education almost never teaches practical money management, which basically leaves us completely unprepared for the real world of wealth building.
And because nobody teaches us this stuff, we're flying blind to some major hidden wealth killers. Like, did you know the real-world inflation rate for most middle-class families actually sits somewhere between 8 to 10%? Governments might report a nice, standard 4 to 6%, but the things that actually matter, like housing, healthcare, and education, are absolutely skyrocketing. Your money is losing its purchasing power way faster than you probably realize.
To combat this, today's masterclass syllabus is going to cover 5 key steps. First, finding your financial baseline. Second, the 50-30-20 budgeting rule. Third, managing good and bad debt. Fourth, navigating the hidden inflation trap. And finally, investing for financial freedom. All right, Section 1, your financial baseline, taking a brutally honest snapshot of your money. At the very core of this snapshot is understanding the fundamental difference between assets and liabilities. An asset is simply something that consistently puts money into your pocket. Think real estate, investments, or a profitable business. A liability, on the other hand, constantly drains money out of your pocket. We're talking high-interest consumer loans or carrying a massive credit card balance. So, when you take the total value of everything you own and subtract everything you owe, you get your net worth. And honestly, this is the magic number. While your monthly income is what funds your daily lifestyle, it's your net worth that actually buys your long-term freedom. The whole game is just using your income to acquire more assets, which steadily pushes that net worth number up and up.
Moving right along to Section 2, the 50-30-20 budgeting rule, a proven framework for allocating your income.
Now that we have our baseline, we need a defensive playbook, and the 50-30-20 rule is a fantastic, highly effective foundation. Here's how you break it down. 50% of your after-tax income goes straight to essential needs, your rent, groceries, the absolute basics. Then, 30% funds your wants, so dining out, vacations, hobbies. And finally, a strict 20% is completely walled off for the future you, savings and investments. Tracking this forces you to see exactly where your money might be leaking.
Next up is Section 3, managing good and bad debt. Understanding when borrowing builds wealth versus when it destroys it. You know, debt generally gets a terrible rap, but it's crucial to realize it isn't inherently evil. It's just a tool. Good debt means you're borrowing money as an investment to increase your future wealth, like expanding a business. But bad debt, that completely destroys your financial stability. The absolute worst offenders are things like payday loans. They can carry mind-blowing annual percentage rates anywhere from 300 to 800%. Borrowing money for consumer goods at those rates is just digging yourself into a massive hole.
Listen, if you are currently stuck in bad debt, do not panic. You have 2 scientifically proven escape routes. Route 1 is the debt avalanche. This is where you attack your highest interest rate loans first. It's mathematically the most efficient way and saves you the most money. Route 2 is the debt snowball. Here, you pay off your smallest balances first, completely ignoring the interest rate. Why? Because it gives you quick psychological wins and builds that emotional momentum you really need. Just pick the one you know you'll actually stick with. Which brings us to Section 4, the hidden inflation trap, the invisible enemy destroying your savings. Once your budget and debt plans are locked in, we have to face this invisible enemy. Remember those inflation numbers we talked about? Governments target 4 to 6% inflation, but major life expenses like healthcare and education are soaring by 10 to 14% a year. Now compare that to a standard bank fixed deposit netting your maybe 5.18%. If your expenses are growing at 10% and your money is only growing at 5%, you are mathematically moving backward.
So the terrifying reality here, and you absolutely must take this to heart, is that leaving your cash sitting idle in a regular savings account is a guaranteed way to lose wealth. Yes, the number in your bank account stays the same, but what that number can actually buy shrinks every single day. Saving is a defense mechanism for emergencies. It is not a wealth-building strategy.
And that leads us perfectly into Section 5, Investing for Financial Freedom, the boring but proven path to generating real wealth.
Look, if you spend any time on social media, you're constantly bombarded with hyper-fast trading schemes or wild crypto bets promising to make you a millionaire overnight. But the hard data proves that the quickest way to get rich is usually just the quickest way to get poor. True, lasting wealth is actually built through the incredibly boring but incredibly reliable method of long-term investing in things like index funds.
The absolute magical engine behind this boring approach is compound interest. It's wonderfully simple. Your money earns interest, and then that accumulated interest starts earning its own interest, creating this massive snowball effect over the decades.
To put that into perspective, historically, the S&P 500 returns roughly 10% annually. So if you were to take $100,000, invest it, and literally do nothing but wait 20 years, it could miraculously grow to roughly $670,000. You really don't need a finance degree for this. You just need patience and the discipline to remember that time in the market will always be trying to time the market.
As we bring this explainer to a close, we really have to remember these legendary rules from Warren Buffett. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now that doesn't mean your investments won't bounce around day to day. It means you must practice risk management, avoid those crazy get-rich-quick schemes, and build a robust, long-term portfolio that can weather any storm.
But listen, out of all the stocks, real estate, and bonds out there, your ultimate asset? It's you. The very best investment you will ever make is in your own education, your skills, and your habits. So I want to leave you with this question. Are your daily financial habits building your ultimate freedom, or are they just quietly funding someone else's? It's time to take control. Thank you so much for joining me on this explainer. Be sure to hit subscribe to keep upgrading your financial IQ with us, and I'll see you in the next one.